Let's talk about price to earnings ratio. Price to earnings ratio is a share valuation metric used to assess a company's stock value by comparing its share price with its earnings per share, or EPS. The equation as follows: PE ratio equals share price over earnings per share, which we talked about in the last video. So we know all about the EPS now. Imagine you're at a lemonade stand considering whether to buy the whole business. The price to earnings ratio, or the PE ratio, is looking at how many cups of lemonade stand sells, which are the earnings, compared to the price of buying the entire stand, which you can call it a share price. Let's break it down. This is how much money you'd have to pay to buy the lemonade stand, and the earnings, this is how much profit the lemonade stand makes usually over a year. Now, imagine the lemonade stand makes $100 in profit, which is the earnings each year. If the owner is selling the entire lemonade stand for $500, then the price to earnings ratio is 5, and that's $500 divided by $100. So in simple terms, the PE ratio tells you how many years it would take for the lemonade stand's profits to pay back the cost of buying the stand. A higher PE ratio could mean either that the lemonade stand is making a lot of profit relative to its price, which could be a good sign, or that the price of the lemonade stand is high compared to its earnings, which might not be as good. Similarly, a lower PE ratio could mean the stand is cheaper relative to its earnings, or it might indicate that the stand isn't making much profit compared to its share price. Now let's use a practical example of a company that we can evaluate its stock price. And we can use Yahoo Finance to give us some data regarding on this. Let's just say we'll choose, say, Apple. We'll take Apple's data to see how we can calculate the PE ratio, and once again, the equation is share price over the EPS, and you can see in this data, the graph from Yahoo Finance, or the numbers, it says here the figures. The share price is 183.86, so that goes in the numerator, which is the share price, and you divide it by 6.44, which is the earnings per share. You can see this in green. And that gives us a number of 28.549, which we can round it off as 28.55, which is what Yahoo Finance did. They just rounded it off. So based on this PE ratio, is Apple overvalued or undervalued? Now, let's just pretend that Apple only has 3 competitors within its whole industry. I'm only doing this mainly because it's mainly for simplicity's sake, really. Because if we compare Apple to the whole industry, there's just a lot of companies that touches those industries, and it would take a long time before we can actually see if the PE ratio for the whole industry is either overvalued or undervalued. Now, as you can see, we've got Samsung Electronics here, Dell Technologies, and Microsoft Corporation, which are 3 very well-known companies and also well-known competitors of Apple. So you can see here Samsung, the PE ratio is 15.46. Dell Technologies has a PE ratio of 22.9. And Microsoft Corporation has a PE ratio of 36.77. So if we take the average of these 3 company stocks, we get an average PE ratio of 25. So that means Apple's PE ratio is just slightly overvalued because it's at 28.55. Now we need to know that PE has its own limitations, and one of those limitations is industry variations. Different industries have different average PE ratios. Comparing PE ratios across industries may not provide a meaningful analysis, as some industries naturally have higher or lower valuation metrics due to their characteristics. Also, There are also differences in accounting standards, which the PE ratio doesn't really capture. Differences in accounting standards across regions or companies can impact the comparability of PE ratios. Investors should be cautious when comparing PE ratios of companies in different countries or industries. PE ratio also has a short-term focus and are based on historical or trailing earnings and may not capture the market's expectation for future earnings. Investors looking for growth opportunities may find the PE ratio less informative for high growth companies. PE ratios are also not applicable to companies with negative earnings. In such cases, alternative metrics like price to book sales or price to book ratios might be more relevant in this. The PE ratio also ignores growth rate. It does not directly consider the growth prospects of a company. Two companies with the same PE ratio might have different growth rates, and this crucial aspect is not captured by the PE ratio alone. So, once again, the PE ratio or price to earnings ratio is a crucial valuation metric for investors as it reflects the relationship between a company's stock price and its earnings per share. And investors typically use this ratio to assess a stock's relative attractiveness and potential for future returns.